So far, I've talked about gold, about speculation, about growth. Now it's time for the fourth piece of the puzzle, yield. You need to own a stock with a big, high-yielding dividend, at least one. But unlike when we diversified by sector, owning multiple high-yielders is a good thing. Dividend-paying stocks may not be as sexy as speculation or high-octane growth names. But you know what? Who needs sex appeal? Dividends work. I like them more than high-octane growth, for certain. Buying high yielders and then reinvesting your dividends in these stocks over time is one of the greatest ways to make money out there. Plain and simple, the power of compounding. It allows your investment to compound over time, meaning the money from your dividends pays dividends, giving you compounding and increasing dividends. People think that high yielders are only about safety or generating income in your retirement. But, you know, if you go back to January of 1926, a long time, about 40% of the return from the S&P 500 has come from those reinvested dividends. That's how essential they are to capital appreciation. Wall Street gibberish for growing your money. Dividend stocks aren't merely a place to hide when the market gets rough, although they do represent a fabulous safe haven in difficult markets. They're not just for retirees who only care about capital preservation, although, again, they do a terrific job on that front. They're for young people, too. Investing in high yielders, remember, a young person compounds many more years than if you're older. Investing in high yielders is first and foremost one of the smartest strategies out there for making money. It's also one of the safest. Since dividend stocks have a cushion, it's called yield support. It helps them hang in there when everything else is getting annihilated. As the share prices fall, the yield increases and eventually gets to a level where it's just too attractive for investors to ignore, typically against other fixed income securities. That's why I devoted a whole chapter, an entire chapter in Getting Back to Even, which, believe me, is the guide for this surviving this volatile and unfriendly market, to just dividend investing because it's gone out of style. I need to bring it in style for you. It's why I like accidental high yielders whenever you can find them. That's stocks that yield more than 4%, not because of dividend increases, but because their share price has fallen so far, so fast, that it's caused the yield to skyrocket. It's why I like the stocks of companies that have recently raised their dividends, as a dividend hike is one of the clearest signals management can send about the true strength of its business. You don't raise your dividend if it's bad. A company that can raise its dividend is one that has steady, reliable growth. And equally important, it's a company that you can be pretty darn sure won't be cutting the dividend anytime soon. Even better are the outfits that have put through dividend increases for 20, 30, even 40 or more consecutive years. That's the real stability. But other than accidental high yielders and dividend boosts, how do you analyze a high-yielding dividend stock? Just like when you're learning to drive, think safety first. High yields are attractive, but a very high yield could often be a signal that the dividend is unsustainable and will ultimately have to be cut, a red flag, which is why you have to put these stocks through a rigorous safety inspection. If the dividend is sound, maybe the company can raise it too. But if it seems endangered, you got to stay away. What do you look for to tell if the dividend's safe? First and beyond everything else, we look at the earnings per share. My rule of thumb is that if a company has earnings that are greater than twice its dividend payout, we know it can sustain the dividend even in lean times when the earnings would be shrinking. In that case, you're home free, the dividend's safe. If not, you need to go to step two. I need you to look at the cash flow. Especially important when dealing with companies that have a lot of machinery or other heavy capital investments like pipelines, which cause them to report high depreciation and amortization costs. I want you to also think about, in that light, you'd be thinking about the Verizons and the AT&Ts, the communication networks that don't come cheaply, or the tower cell phone companies. These depreciation and amortization costs don't come out of a company's actual cash, though. But they do skew the earnings lower, which is why the cash flow can often give you a better idea about whether or not the dividend is sound. Finally, you have to look at the balance sheet to make sure there isn't a lot of debt coming due in the near future. Hey, listen, they owe money to the bank. Believe it, they're going to cut your dividend. They're going to cut the dividend, the common stock first. Finally, you need to know how to actually collect the dividend. Forget all the jargon like the declaration date, the X date, the record date. On Mad Money, we care about only one date with dividends, the must-own date. That's what we call it. That's what I call it in Getting Back to Even. That's the last day you have to buy a stock in order to be able to claim its next dividend payout. The must-own date is always the date before the X date. That's the only thing you need to know, the must-own date, okay? The bottom line, if you want to embrace the new diversification on top of the mandatory old-fashioned sector kind, if you want to be prepared for every kind of market out there, then you absolutely must own a high yielder. Dividends protect your stocks, and they're also a terrific way to make money. What's not to like?